Welcome to Quiver Financial's market update for March 2024. Find out what we're seeing in stocks, interest rates, metals, and oil. I'm Colby McFadden with Quiver Financial, joined with Patrick Moorhead and Justin Singletary. Gentlemen, welcome to March of 2024. Did you talk about gold since we just talked about Bitcoin? And like I said, they do seem to attract similar concepts and beliefs. So here's what's been going on with gold. Here was our previous chart back in December. So we had talked about it looked like this was going to be a breakout, and we needed to see gold kind of pivot right here. And that's exactly what happened. This basically was about the time frame. Right here was about the time frame we were looking for that pivot. And now you've broken out above resistance. And it looks like the move is just kind of getting started here. And now, how high does it go? Give me some time. Let me see where this leg tops out, and then I can give you some projections. But right now, the trend is your friend in gold. And the nice thing is that, if you looked, I didn't put a chart of gold miners in here, but what's interesting, if you looked at gold miners, you'd see that they had kind of like traded all the way down here. So if you saw a chart of gold miners, you'd have this rise up, and then they tanked and they traded lower. And what I've seen in the years in my past is that if you have gold, the asset breaking out, and the miners have been lagging, then all of a sudden they do play a catch-up. So that's what I'm watching there, because we have a decent allocation of gold miners now inside the accounts. And so right now, the trend in gold looks positive. What could be the flip side is basically you break back below this 190 level, which doesn't seem likely now, but anything can happen. That becomes your stop loss level. And eventually, once we see where this rise starts to peter out, we'll be able to create another stop loss level a little bit higher. So the trend looks good. And I think that I like what I see there. Fundamentally, the dollar, gold has had this much strength, and the dollar's been pretty strong. Normally you see gold make runs like this when the dollar's had a lot of weakness. And the dollar as a currency compared to other currencies has been very firm the last year and a half, while gold has been starting to break out higher. So gold is acting on its own, and I don't know if that's a precursor of concern, but it is doing what it's doing. Justin, I know you had some gold necklaces you wanted to share.
Well, the last time I talked about gold to a client, he was like, "Gold's not sexy," and I said, "Well, if gold hits 2,500, is gold going to be sexy at that point?"
Gold, you know what? Gold's not sexy. He better talk to Mr. T.
Yeah.
I don't know. Yeah, I mean, it's not sexy, and everybody's going to criticize it. But it's moving, and there again, when I look at the gold miners, and here's some companies that are paying 3%, 4%, 5% dividends, and the thing that they pull out of the ground and sell has gone up in price, and their share price has been at the lows for the last year and a half. It seems like a dislocation to me. And the best way to make money in markets is to find dislocations. So I think this is a good one for people to pay attention to. Justin, you have anything to add to that, or should I move on and then wrap it up with oil?
I think what's interesting is like you touched on briefly is, usually in the past when gold has started to rise, you've had a weaker dollar. What's interesting is that where we are and how these things are starting to shake out, because I feel like there's probably, you have stock markets hitting new highs, you have the ETF, Bitcoin stuff, you have gold rising, you have dollar staying strong, so there's these weird things that are going on. And I feel like those are indicative of times that are not a bull market in front of us, but you've been around more markets than I have, but at least the few that I've been around.
Well,
play it the same way.
Yeah, as you say, like talk about all those dislocations, how everything's not all moving in one mass. You can see it in portfolios. Most people who have a diversified portfolio, they can see their portfolio struggling the last 2 or 3 years because there's been a trend in one area but not another. And like you haven't had a situation the last 3 years where you have multiple sectors, multiple asset classes all moving in one direction. You've had situations where stocks move and bonds go the other way. Like you've just had this horrible tug of war, and that hasn't ended. I think that gives evidence that the Fed is if this was a baseball game, the Fed is in the 7th inning of their process. Like they've subtracted enough liquidity to create these dislocations, all this unevenness in the market, but they haven't subtracted enough liquidity to really bring all of them down and get them to reset at a lower level, right? So as you were saying that, it made me think, well, okay, we'll watch for the future. Does the Fed continue to extract, are they just trying to figure out where that liquidity level is, where that teeter-totter is? Because that's what they did as they lowered rates is, and we talked about it for years that they were pushing on a string, and then boom, after the pandemic, they caught fire, inflation came on. This is the same process, but on the other side. They're now going to have to push on the interest rate string to figure out, okay, where does that pull enough liquidity out so we can slow the economy down and we don't have 9% inflation? So I think what you're seeing in the markets by people's portfolios and by all these asset classes kind of fighting over the last couple years and even into this year is just that the Fed is late in this tightening cycle, and you've taken enough water or liquidity out of the system to make certain areas dry, but not all of them. All right, let's wrap it up with oil. Yeah.